What if I told you the US economy is walking a tightrope? On one side, a potential recession, and on the other, stubbornly high prices. And right in the middle, the Federal Reserve is about to make a move that could send ripples through your savings, your investments, and the entire stock market. Hello everyone, and welcome to the channel. Today, we're diving into the Federal Reserve's anticipated interest rate cut in September 2025. We'll break down what this actually means for you, for the stock market, and for key industries like real estate and tech. If you've ever wondered how these big decisions actually affect your wallet, you're in the right place. So, why all the fuss about an interest rate cut? Think of the Fed as the country's economic doctor. When the economy is weak, the Fed can cut interest rates to make borrowing cheaper, encouraging businesses and people to spend, and stimulating growth. But right now, the economy is sending mixed signals. Fed Chair Jerome Powell described the labor market as being in a curious kind of balance. What he means is that while the main unemployment number looks stable around 4%, job creation has slowed down significantly. We're seeing an average of just 35,000 new jobs per month recently, a sharp drop from over 168,000 per month back in 2024. This is because fewer people are entering the workforce and companies are hiring less. The Fed is worried this delicate balance could tip over, leading to a sharp rise in unemployment. So they aren't cutting rates because we're in a crisis today, they're doing it to prevent a crisis tomorrow. Now, here's the tricky part: inflation. We all know prices are still high. The Fed's target is 2%, but we're at 2.6%. A big reason for this is new tariffs on imported goods. The Fed is betting these tariffs are causing a one-time shift in the price level, not a long-term inflation problem. They're essentially gambling that a slowing economy is the bigger threat. And when Chair Powell hinted at this cut, the markets loved it. The Dow Jones jumped over 800 points. This suggests investors believe the Fed is making the right call. Now, you might be thinking, great, a rate cut means the stock market is going to the moon, right? Not so fast. History shows it's more complicated. The key lesson is that why the Fed is cutting rates matters more than the cut itself. If they're cutting rates to fight off a major recession, like in 2007 or during the dot-com bust, the market can still fall. This time feels more like a soft landing scenario, where the goal is to keep a slowing economy from crashing. Historically, that's been a positive environment for stocks. But this cycle has a wild card: those new tariffs. They add a layer of uncertainty, which means we should probably expect a bumpy ride. So, if a rate cut is coming, who are the likely winners? Let's start with the obvious one: real estate. Real estate investment trusts, or REITs, own properties like apartment buildings and data centers. They benefit hugely from lower rates for two reasons. First, they borrow a lot of money, so lower rates mean lower costs and higher profits. Second, lower rates make property values go up. To put it simply, the value of a property is based on its future income. When the Fed cuts rates, that future income becomes more valuable today. Right now, some subsectors look especially strong. Data centers, fueled by the AI boom, and industrial REITs, thanks to e-commerce, are seeing incredible growth. Next up, the tech sector. The moment Powell hinted at cut, the tech-heavy Nasdaq shot up. Just like with real estate, it's about future earnings becoming more valuable today. Many tech companies aren't profitable yet. Their value is based on the huge profits they expect to make years down the road. Lower rates make those distant earnings look much more attractive to investors today. Okay, so real estate and tech are celebrating, but for banks, it's a double-edged sword. Banks make money on the spread between the interest they earn on loans and what they pay on deposits. When rates are cut, that spread can get squeezed, hurting profits. However, lower rates can also spur more people to take out loans, so banks might make up for the smaller margins with higher volume. It's a mixed bag. Now, there's one more piece to this puzzle that makes this situation unique.
While the Fed is cutting its main interest rate, it's also doing something called quantitative tightening, or QT. Think of it this way. The Fed is slowly removing money from the financial system by letting its massive bond portfolio shrink. So, hold on. The Fed is cutting rates to stimulate the economy, but also removing liquidity, which tightens conditions? Yes, it sounds contradictory. They're using the rate cut for the short-term risk of a recession while using QT to deal with longer-term issues. What does this mean for the market? Probably more volatility. It's an unprecedented experiment, and nobody knows exactly how it will play out. So, what's the big takeaway? How should you prepare? First, don't get complacent. A rate cut doesn't guarantee a smooth ride. Diversification is your best friend. Make sure your portfolio is balanced and aligned with your long-term goals. How you act really depends on your personal risk tolerance. If you're more a conservative investor, you might focus on high-quality, dividend-paying stocks in sectors like utilities and real estate. These provide steady income, which is more attractive when rates are falling. If you're more aggressive investor, this could be a time to look at sectors poised for growth, like technology and small-cap stocks, which get the biggest valuation boost from lower rates. Ultimately, the Fed is navigating a very delicate situation. They are trying to land the economy softly while dealing with tariffs and political pressure. This video is for educational purposes only and should not be considered financial advice. Please consult a professional before making financial decisions. The next few months will be fascinating. By understanding the forces at play, we can be better prepared for the road ahead. If you found this useful, hit that like button, subscribe, and share it with a friend. And let me know your thoughts in the comments below.